Hola amigos, Daniel here from Infovest. Just want to do a quick video on talking about an interesting article that comes out from MarketWatch. The title of this article is Fed says banks could withstand 10% unemployment and 55% stock price drop in an annual stress test. So pretty bold headline here, especially using the word 55% drop in stock prices. If I scroll down a little bit and I just read here in the article, and I'll post it in the description here. The Federal Reserve Board on Thursday projected the potential for a rockier road ahead for banks than it did a year ago, but said that 33 financial institutions it reviewed passed its annual stress test of capital reserves. Okay, so the Fed estimated about $612 billion in potential losses for banks in its most severe economic scenario, and said even if this comes to pass, banks would still be healthy enough to provide loans to homes and businesses to keep the economy afloat. I think if the market's dropping 55%, very less likely that you'll see people going out and getting loans, except for the people who have the capacity to do so. So anyways, that's basically a 50 billion more severe loss projected than a year ago by the largest banks. Now, this year's hypothetical scenario is tougher than 2021's test by design and includes a severe global recession, the Fed said in a statement before. The Fed's model included 5.75% increase in the unemployment to basically 10%, and a 40% decline in commercial real estate prices, and a 55% drop in stock prices. Okay, so all of this that is coming out is pretty interesting. This comes out at a time where Federal Reserve is coming out, testifying in front of Congress, and coming out, and you're hearing specific, and I did a video on this before, you're hearing specific languages that is coming out from the Fed that has changed since 2021 till this year. Right? And we've been talking about this on this channel for quite some time. I know it sounds like I'm talking about dooms and gloom all the time, and you keep hearing that from me, but it's not supposed to be meant as a video to bring you down about the economy. It's there to warn you, it's there to protect you, and it's there to help you out to see where the opportunities are in this market. And I want to pinpoint something, very crucial thing that I talked about in my last video that I want to talk about now. The language of the Federal Reserve, and a lot of people are not paying attention to this, it has shifted quite a bit over, especially this year. We started hearing from the Fed that they were going to see basically a soft landing in the beginning of the year. Then they started talking about, use the word, and no one really picked it up, right? Use the word from soft landing to soft-ish landing. And then we had basically a reporter that came out and said, what do you mean by soft-ish landing? And the Fed came out and said, just like, when you see a plane fly down, it may not be perfect landing. It's still going to be a good landing, but, little teeny bit bumps here and there. It's still going to be a soft landing, but just a soft-ish landing. The fact that he started to use the word from soft to soft-ish was the clue, the beginning of what we're seeing today in today's kind of comments from the Federal Reserve, right? So we heard, and I'm just going to, again, pull it out again. We heard from the Federal Reserve come out and talk about a lot of these things, come out and say, that, things in the economy, there are external factors out there that they have no control over, like supply chain, the Chinese lockdown, the war in Ukraine and between Russia and Ukraine, the increasing oil prices and whatnot. This is all putting inflationary pressures up. And when you see consumer expectation on inflation and in prices, you're basically seeing them expecting higher inflation coming down the road. Also, Bank of Canada, or we had the CPI report in Canada as well, where it saw also higher inflation. And again, consumers are also expecting higher inflation. And as long as that inflation continues to be higher and the expectation continues to be higher, you'll see it's a self-fulfilling prophecy where prices will continue to increase, right? You know, when you look at, think about it, when you look at people who are shopping in the markets, and people, you might know friends and family that talk about, oh, prices are increasing, oh, prices are increasing, oh, well, what can we do? That damn inflation, right? Coming out and saying that. People are using the excuse of inflation as, you know, a problem, but hey, they got no choice, let's just buy anyways. And with that type of mindset, again, it's a self-fulfilling prophecy that, oh, inflation and prices are increasing, but I got no choice, I gotta buy this, so here you go, here's my money. And especially in key items like food, like utility, energy, oil, etc., these continue to be elevated, and you can expect this continue to be elevated, especially into next year as well. So, you know, the testimony that Powell did today and yesterday, we saw a lot of comments shift from the softish kind of soft landing language, to now the Fed basically saying that, hey, you know, it is possible you could see interest rates go up, continue to go up, which basically might maybe lead the economy into a recession, right? An economy into the recession, and it's going to affect the economy quite a bit. And again, we want prices to come down. That's the main goal. The main objective of the Fed is to bring inflation down, to bring prices down, and you're going to see that from the continuous rate hikes that are coming from the Fed, right? So that continues to be a problem. That continues to be an issue. And again, just watch the transition of the language, and the fact that now this article has come out on Market Watch, and the Fed coming out and saying that they've done a little bit of a more rigorous test this year than they did in 2021. And I think there was a comment here in this article where they basically said that, hey, you know, don't worry, this stress test doesn't mean that we believe the economy is going to have a severe recession or anything like that. You know, to be honest, when, you know, if you're going to do a rigorous stress test like that, it definitely means that you are worried about something, especially if it's more than what you did previously, especially last year. And especially as you hear the commentary change from basically the Fed going from predicting soft landing to softish landing to saying, hey, you know, just be careful that, you know, maybe interest rates, these interest rate hikes that we're doing may lead to a recession and may lead for the markets to come down. And the fact that they're projecting something like a 55% drop in stock prices and a 10% unemployment, even though in the projections in the FOMC meeting that they had, they didn't have that in their projections. But the fact that they're doing these stress tests and these models just say that, hey, this is one option, this is one path that the economy and market can go to. And I think it is definitely, you can see definitely prices to come down. I know prices in the stock market has already dropped. If you look at NASDAQ, about 30%. And we haven't even seen panic yet, right? We're all, you know, the US is around 1.75% in terms of interest rate. They want to get to, you know, 2.5% in the next month or two, right? And with their basically aggressive rate hikes that they're doing, right? If you already are seeing pain in the economy with 1.75%, how will it look like when we get to that neutral zone of 2.5% or even more, right? The Fed wants to continue to raise rates and continue to be aggressive and continue to move also into restrictive territory. And if we're already feeling the pain right now, what is it going to look like when you see rates elevate even more? To those restrictive levels. So I think that, you know, it's possible you can see a continuation of this fall in the equity markets, and definitely it is a very it's a big possibility, and it's probably already true that we are in a recession right now unofficially, right? We have to wait till the data comes out to say, hey, we're officially in a recession. And I think it's very likely that the Fed will also continue to raise rates while we're in a recession, which is eventually going to break something in the economy. You're going to see, corporate debt levels skyrocket, and it's going to be a lot of pain for a lot of corporations who might go into bankruptcy and start to default on their debt, especially when you look at the 10-year yield continuing to rise. And if you continue to bump up that interest rate, those interest rates and hiking interest rates, that's going to bring that 10-year bond, those yields to increase, which is going to really pinch corporations quite a bit, right? We had also Netflix came out and they basically laid off a bunch of employees as well today, right? I think the number, don't quote me exactly what it is, but I think it's something like 300 or something like that. I think so. if you remember the number, just comment below. But yeah, so you're seeing that effects of corporations. You can definitely see unemployment increase, and 10%, sure, that could definitely be a possibility. 50% of the equity markets, sure, dropping, sure, that could also be a possibility. So definitely, when you look at the equity markets itself, yes, it has fallen 30%, but that's not true pain. That's not true pain. That's not what a true sell-off looks like. If you want to look what a true sell-off looks like, check out the chart on Bitcoin. The chart on Bitcoin where we were just a weekend ago around 20,000, and we kind of sold off and had a massive shakeout, which basically where a lot of people probably got margin called at the same time, and you had massive selling on Saturday. That's what real panic selling looks like. And you haven't seen that yet in the equity markets. So I think it's definitely a possibility. It's definitely something that when you see the Fed start to act and sound defensive, especially where they started to sound very, okay and nimble and say, hey, don't worry, soft landing's there, to now sounding a little bit worried, definitely it's not looking good. And don't forget also about other countries out there as well, right? And other nations as well, like Europe, for example, right? Europe is in even a bigger problem than the rest of the world. And if Europe goes down first, then definitely that's also going to affect North American markets as well. And again, I'll repeat it like I said last video as well. Real estate prices, the Fed did come out and said they want to bring in prices down. They mentioned in the article of stress testing with also commercial properties as well. They didn't mention about residential, probably because they don't want to spook the markets too much. But these are already signs to not tell you gloom and doom kind of scenario to worry you or keep you up at night or stressed, but to keep you aware of the situation, and definitely how you can also take advantage and the opportunities in the markets when this happens. So let me know what you guys think. Again, I'll post the the link to the article in the description. Let me know what you think about this stress test. What do you think about equity markets, crypto, bonds, etc. Leave your comment below. Give this video a like, and I hope to see you in the next video. Thanks. See you guys later. Bye.